Financial ratios. These are values we're going to get from financial statements that are going to allow us to compare one firm over time or two similar firms. But there's an important thing to start off right off the bat is we only want to compare, if we're going to compare two firms, they have to be similar. You can compare Exxon and Chevron, but you can't compare Exxon with Apple, or particularly with a bank, right? You never compare Exxon with JP Morgan, right? So what these financial ratios are going to do is allow us to look at one firm, how its performance has changed over time, and compare similar firms. One thing you want to keep in mind before we go through these is it's important, first and foremost, to know what question you're trying to answer, because there's going to be quite a few different categories of financial ratios, and they all answer a different thing. So one of the things that you want to stay away from, what you don't want to do, is start giving random ratios to answer questions, and this happens all the time. I'll give you, before we jump in, I'll give you a quick example. Short-term solvency, the first category of ratio, is going to measure how a firm, their ability to pay bills over the short term, right? So as an example, if I were to say, well, we were looking at stocks, maybe you work at a hedge fund and say, okay, which stock should we purchase, right? If you're going to buy a stock, this is a capital market security. It's a long-term security. It's infinitely lived. Stock is infinitely lived. So you don't really care about the ability over the next 6 months to pay its bills. Now, if there was, there was an anomaly, if there's a real big red flag, then you may want to say, okay, well, look, the firm can't pay its bills over the next 3 months. But that's an edge case. It's very rare. The idea here is if you're going to do analysis of a stock, you don't really care about short-term solvency ratios, but you will see people say, well, the quick ratio is this. So first and foremost, you want to start with what's my question, and then use the appropriate ratios to answer your question. Another note I'll say here, in some textbooks it says, well, know the units of the ratio, and that's fine. However, I would amend that and say, what you really want to do is be able to use it in a sentence, because you may go into a meeting and you say the current ratio is 1.1, and somebody in the meeting may say, well, what does that mean, right? You don't want to say, well, it's in a unit of times, right? What you want to be able to say is, well, if the current ratio is 1.1, then we have $1.10 of current assets that we're going to turn into cash over the next year to pay our liability. So every payment we're going to have to make over the next year, we have $1.10 in current assets, and assets that will turn into cash within the next year. So all our short-term liabilities are covered, and we have a 10-cent cushion. You want to be able to say something like that. All right, so that's a couple overviews. Let's go through some ratios. Now, we categorize the ratios. So we have short-term solvency, long-term solvency, asset use, profitability, and market value. Again, all throughout this course, I'm going to mention we don't classify things arbitrarily, or I will never use just an arbitrary classification. If we ever classify something like primary or secondary market, there's a reason for it. And the reason why we have these different classifications is, again, certain analysts, financial analysts, will specialize and use a lot of these ratios. So if I'm at something like Federated Investors, I run money market mutual funds, then I care about really the only thing I care about if I'm running a money market mutual fund, because I'm buying corporations' commercial paper, short-term unsecured debt issued by corporations. The only thing I care about is their short-term solvency ratios, right? So money market mutual funds will look at these ratios, whereas mutual funds who invest in stock, hedge funds, and so forth, they're not going to care about this. They're going to care about long-term solvency, and more of these measures over here. So the idea is the broad categorization, it makes sense, right? And you as an analyst may only use, from a couple of these categories. Okay, so short-term solvency, this measures the firm's ability to pay its bills over the next year, right? So we mentioned the current ratio. This is current assets divided by current liabilities. I'm not going to go through every short-term solvency ratio, just some important ones for each category. So again, like I said, if this is 1.1, that means I have, for every dollar that I'll owe over the next year, I'm going to receive $1.1 in cash, right? $1.10 in cash. So Another aspect of these is whenever we come upon a ratio, you should know what's a good value, right? So 1.1 might be a good value, right? What values do we not want to see for the current ratio? We wouldn't want to see less than 1, and again, we wouldn't want to see 5, right? If the current ratio is 5, for every dollar you're going to have to pay, you're going to get $5, and that means you probably have too much cash lying around. So, 1.5 is fine here, maybe 2. Again, industry specific. But the idea here is we don't want this one to be too low, we don't want it to be too high. A little above 1 is good. Now, as another example here of what you can think about in terms of ratios is how to improve them. Meaning, and this is, these are just general, we're teaching, general finance here, but once you get into a specific industry, you're going to tweak these ratios given the particular aspects of your industry, right? So, an example here is the quick ratio. So maybe inventory in your industry is not that liquid, meaning it's hard to turn into cash. Maybe you sell airplanes, right? Maybe, I would imagine, I've never worked for an airplane, I've never worked for Boeing or Lockheed or anything like that, but I'd imagine their inventory is pretty illiquid if they have an inventory. For those types of firms, we may say, okay, well, I don't care about your current ratio because you've got a bunch of airplanes sitting in here. So let's take out your inventory. So the quick ratio is current assets minus inventory divided by current liabilities, right? So this may be more relevant for your particular industry, and this is how we come up with these financial ratios, right? So we try to make them more relevant to particular industries and particular firms, right? So we have current ratio, we have quick ratio. Long-term solvency. So this is your firm's ability to pay bills over the long term. I have as an example here the debt to equity ratio. Other examples of long-term solvency would be total debt. So debt to equity is just debt over equity, obviously. Total debt ratio is debt over assets. One other that will be important here is equity multiplier, and that's just 1 plus the debt equity ratio, which should be assets over equity. And you can manipulate this. I'll give you this as an example. Do I have an eraser? Yeah. So, one way, and this is kind of useful just for getting used to these ratios. So if I tell you the equity multiplier is the debt to equity ratio plus 1, well then you can find a simpler, statement for this. So the idea here is 1 is just equity over equity, right? Equity divided by equity, that's 1. So then I can add this, and this is debt plus equity over equity, right? Debt plus equity is assets, so this is assets over equity. So this would be the equity multiplier, right? And you can, with some algebra, always manipulate around these financial ratios. And if you do that, you learn them, you get to know them fairly well. Now, here's another point, I think I alluded to it earlier, but all these ratios are saying the same thing, right? Total debt ratio, debt to equity ratio, equity multiplier. So what you don't want to do in a meeting, you go into a meeting with your boss and say, well, the firm's total debt ratio is this, the debt to equity multiplier is this, and the debt to equity ratio is this, right? Because it's repetitive, right? You're saying, you just give 1, right? So you want to, again, you have a specific question you want to answer, and then you'll give a financial ratio to answer that question. And if the question requires a couple ratios, you might want to give a debt to equity and then a profit margin, like a profitability. But just repeating 3 ratios that are telling you the exact same thing. Like I said, I can algebraically get from one to the other. Total debt ratio, that's debt over assets, and I can algebraically get to that here. So that's you want to make sure you don't do that. There are other long-term solvency ratios that aren't just trivial. So in other words, but they are, again, highly correlated, but we could get something like the times interest earned ratio, which is EBIT over interest. So, there may be scenarios where you're like, well, the debt to equity ratio, because this is really a measure of capital structure. So you can say, well, the capital structure, the debt to equity ratio is this, but they have, this amount of EBIT covering their interest payments. So there could be a reason to use both of those in a presentation. Okay, so next is, now long-term solvency, just what values are good. This is highly industry specific. Remember, this is measuring financial leverage. So if a firm has very safe, their assets generate very safe cash flows, then they will tend to have higher levels of debt. Because if it's very safe cash flow, then maybe they only have a 5%, expected return, right? So I can lever that up by increasing my debt to equity ratio, increasing debt in my capital structure, and turn that into a 10, 15, percent, rate of return. So the idea here is generally when the firm has assets with very safe cash flows, they'll use more leverage. But if you're a young firm, you have very variable cash flows, then adding any leverage, one, your expected return is already high, so you don't need to lever it up. And two, like I said, if you have safe cash flows, it's not increasing your probability of financial distress. But if you're Snapchat or some young firm with very variable cash flows, and you load up on debt, you may increase your probability of financial distress. So this is really industry specific, right? So you would expect young tech firms. So all you want to see here, if you're looking at a firm, is if they're very variable cash flows, their cash flow from assets, then they have a low debt to equity ratio. If the cash flows are safe, then they're free to have a high debt to equity ratio. Okay, next category is asset use efficiency. So here, my favorite is total asset turnover. So the idea here of this is how much sales do you generate for every dollar in assets, right? So if I say total asset turnover is 3, and somebody says, well, somebody in the meeting says, well, what does that mean? That says, for every dollar in assets, we generate $3 in sales. What do we want? We'd like this to be as high as possible, generally, right? So, for our given unit of assets, I want to generate as much sales as possible. This is a measure specifically of how efficiently management is using those assets, right? Are they idle? Are they doing nothing? Or are you generating sales with those assets, right? So that's what these categories. You also have things like inventory turnover, cost of goods sold over inventory. People will say how many times do you turn over your inventory? In other words, you're not just having a lot of inventory just sitting there, which is a waste. Next category is profitability. This is some important ratios here. Return on assets, return on equity. We're going to talk about these. We're going to talk about the DuPont identity next, where we have ROA, ROE, total asset turnover, profit margin. So some of these you're going to see in the next lecture. But return on assets, net income over assets, return on equity, net income over equity. One thing that's really important to know is if you calculate return on equity is 15%. This is an accounting rate of return. So never compare that to, well, the market earns on average 9% per year. Okay, that's a market return, right? Or the CAPM, that's a market return. Or treasury bond rates, that's a market return. This is an accounting return, so we do not compare it to accounting to market return numbers. But you can compare. This is Exxon's ROE compared to Chevron's ROE, or this is what Exxon's ROE is looking like over time. So that's how we would use these. The other important one here, I'll mention profit margin. So this, again, profitability measures. We have net income as a numerator, both of these, net income as a numerator here. In profit margin, we have net income over sales. So what this is saying is how well do you control your costs? So if you have a profit margin of 10%, that means for every dollar in sales, 10 cents of that makes it to the bottom line. 10 cents of that dollar makes it to shareholders, right? Whereas 90 cents is eaten up by costs and interest and taxes and so forth. So the idea here is for every dollar in sales, how much is it going to make it to the bottom line to shareholders? So this is an important measure. Lastly, we'll talk about market value measures. The most famous of these is the PE ratio. And the one thing I want to say about the PE ratio, so the price to earnings ratio is the stock price over earnings per share. Earnings per share is net income. In finance, of course, net income is the same thing as earnings. If I say net income and earnings are the same, so earnings per share is net income divided by number of shares outstanding. So we have the price to earnings ratio is the stock price divided by earnings per share. One thing I want to mention here is this is only if earnings per share is positive. Sometimes people will put a negative PE ratio. If earnings per share is negative, then this is not defined. So how do we use the PE ratio in a sentence? And this will make sense. If the PE ratio is 16, that means I'm willing to pay $16 for every dollar in earnings. That's how we would interpret that number, right? And that's why you can see if it has negative earnings, what you should just do is put NA, like a dash, or just no PE ratio, right? Not a negative. So, because you can't say, well, if it was -5, then I'm willing to receive $5 for every dollar for every dollar they lose, it doesn't make sense, right? So the idea here is this is what I have, earnings per share greater than zero. If earnings per share is less than zero, or zero, obviously, if earnings per share is zero, this is not defined, right? So this is strictly, coming from math, I always like to define my domain, right? So this is, for a domain, strictly for earnings per share greater than zero. Good, excellent. Now, one other ratio, a market value ratio that you all see, particularly in terms of in academic, when we're doing factor models and so forth, is market to book. So that would be the market value divided by the book value. So there is some, generally some information in that ratio as well. Excellent. Have a good day.